Hi everyone, today, we are going to discuss one of the important ratios in the stock market, which is the price-to-earnings ratio, commonly known as the PE ratio. We will also take an example of a controversial stock, Adani Enterprises Limited or AEL, to discuss this ratio in detail. First, let us understand what is price-to-earnings ratio. PE ratio indicates how much investors are willing to pay for a company's stock for every $1 of its earnings. It is calculated by dividing the company's price per share by its earnings per share and is measured in terms of times of the earnings. In other words, it shows how much investors are willing to pay for every dollar of the company's earnings. PE ratio is an important metric for investors as it helps them understand the market's perception of a company's future growth prospects. A higher PE ratio generally indicates that investors have high expectations for the company's future growth and vice versa for a company which has lower PE. Recently, Hindenburg's report had a series of allegations against the Adani Group, but apart from those allegations, it claimed that Adani Group's shares skyrocketed irrespective of no significant improvements in the company's fundamentals. As of December 31, 2022, AEL was trading at roughly 4,000 Indian rupees per share, and the earnings per share were approximately 10 Indian rupees. Hence the PE ratio, which can be calculated by dividing share price and earnings per share, was at a whopping 400 times the earnings of the company. As we mentioned earlier, the ratio by itself doesn't provide any insight, and we need to compare it with industry averages or prior year ratios to analyze it in detail. Therefore, we will compare AEL's PE ratio with the industry average to gain some insight. According to this chart from Screener, the industry average is around 35 times the company's earnings, but the price to earnings of the company was around 400 times, which was significantly above the industry average. It depicts that the stock traded at a sky-high valuation. Although AEL shares fell by more than 50% post the Hindenburg issue, its current PE is roughly at 106, but it is still considered to be an overpriced stock. From a personal finance point of view, one should avoid investing in stocks with a very high PE ratio. However, it is essential to remember that PE ratio is not the only point of view from which individuals should invest in stocks. It is also possible that some stocks may have a higher or lower PE than the industry average, but they could still be good stocks because of the respective company's fundamentals and their strategic growth expectations. Therefore, it is essential to analyze the company's financial statements, growth prospects, and other financial metrics before investing in any stock.